just as I said, now all markets currently at one-year highs and really enjoying gains over the past while. Would you say that the markets are fairly valued? Many say that they've run too hard and we should be expecting a pullback.
Well, I mean, look at the company results you've just announced, and look at the numbers that are coming through on the earnings cycle. Yes, it's coming off a very low base, but you're seeing stability as far as earnings are concerned. I mean, Bank of America is probably the outlier in the sense that they continue to lose money, and those are generally due to accounting rules which are quite stringent as far as banks are concerned. But as for the rest of the sectors, you're coming off a very low base, and there seems to be stability as far as earnings are concerned. Okay, very, very low base, but they're slowly starting to increase in value. And the question is, how does one value those earnings? That really becomes the case. Now, if you're a doomsdayer, you'll be sitting today and you'll be saying, no, the earnings is merely a brief pause before things will start continuing, its downward spiral, in which case you'll be sitting in cash and you won't be buying any stock at all. If you're not a doomsdayer and you believe in reality, which I think most investors should do today, you'd be looking at those earnings and you'd be saying, okay, it's coming off a low base, the market has been flooded with liquidity, and that liquidity will find a home at some point and find its way into consumers' pockets at some point. Don't know how long that'll take. It'll probably, maybe if it doesn't take a year, maybe it takes 2 or 3 or 4 years. But that doesn't matter. I'm buying really good value today, and I should be looking at how I could be buying and sharing in the next bull cycle that is potentially in the market.
Many analysts say that the big test for the markets will be when the Fed decides to pull away all this quantitative easing and all the stimulus. Do you think that that will be perhaps a dampener for the market sentiment that we've been seeing lately?
No, I don't think so. I think the Fed has become, the Fed has spoken about continuing their quantitative easing programs and continue to, both from a monetary and a fiscal perspective, continue to stimulate the economy as much as they possibly can. The problem that you've got, and the potential problem that you have, is that their priority beyond this is to recoup some of these losses. Yes, many of the assets that they hold, they've seen some fantastic gains on. If you look at their TARP program, the Toxic Asset Relief Program, I mean, that certainly has given a huge boost as far as profitability is concerned, or as far as returns have been concerned. So they're going to make money off this, and then whatever debt they can't repay, they're going to have to try and recoup that out of taxes and the likes. Now, obviously their focus in the next half a decade beyond the crisis is going to be trying to reducing their deficit, which obviously doesn't necessarily put the focus on the consumer, but puts the focus on federal government. But you still have a system that stands. You still have companies that continue to service consumers with basic goods, and you're buying those companies of relatively good value today. A colleague of mine says, is the market cheap enough for me to mortgage my house and put more money into the market? No, it's not mortgage my house type cheap, but is it cheap enough to be interested in it? Absolutely. You're still buying companies of decent yields.
So at this stage, you're stock picking, because some of the analysts I talk to, they say it's too dangerous to look into these individual companies. And also when you look at the way the sectors have performed, the Indy, the Resi, and of course the Findy, they've all been neck and neck. When you look at the all share, that's probably a safer bet, and that's what many analysts say. I mean, you obviously look at those key companies.
Well, if you're going to do stock selection, you're going to have to understand the companies. If you don't do any stock selection, well then the companies don't matter. Then you're just buying the index. For me, stock selection, I think, is critically important in any portfolio of assets, predominantly because you're trying to understand what the company is, what drives the company, and what fundamentals drive the company. And more important than looking into the company is understanding the earnings streams and the dividend streams that come from a company, and what the company is doing to protect those and to enhance those in the future, given a certain consumer market.
Looking at the South African stocks, I mean, give us some of those stock picks that you are looking at.
No, that would be telling. that would be telling. Let me rather talk about this. If you look at the market back in March, you would have seen a massive amount of fear-based selling, in the market. Massive amount of fear-based selling in the market, where people just continue to sell headlines in the newspapers, on depressions and going back to the 1920s, and that the ensuing World War III is going to be coming. And this is obviously all fear-based selling. But what is keeping the investor away from the market today? It's the same fear-based selling. Today you can go and buy PPC off a good 5-6% dividend yield. You can go buy Tiger Brands off a slightly lower dividend yield. Why is that not good value? I don't understand why people say that is not good value. That surely must be good value out there, and people should be looking at how they could be participating in those kind of situations.
Just looking at the sectors, as I said, the Findi, the Indi, and the Resi have been performing neck and neck. If you take away the stronger rand, obviously the Resi would be outperforming. Which sector are you concerned about in terms of getting a pullback? When you see the retail sales coming in at a contraction of 7%, and of course we'll be hearing those earnings from those key retailers, do you think that we should be worried about specific sectors? On the other end, we know that the resource companies have been rallying on the back of commodity prices being up, but many say the demand isn't really there for these key resources.
If you look at resources and you look at the broad-based miners, so you're looking at your Anglos and your Billetons and so on, you see that those yields are predominantly, and your price-to-earnings ratios are probably are compressed relative to what your financials and your industrials would be looking at. But that's just part and parcel of the mix of what the market is offering at this stage. Would you be buying financials and industrials today? Yes. Bad news is good for stocks because you can buy off lower values. So if you like a Standard Bank and you've bought some at 70 and you've bought some at 65 and you're now going to be buying some more at 90, it's still good value. It's not like it's that the company has changed. You're not buying these stocks of 150 and 160 rand. You're still buying value. Yes, it's not as good value as what it was at 65 or 70, but you're either going to be part of the bull market or you're not going to be part of the bull market, And the only Armageddon that you're going to get out of the markets today is if there's some terrorist attack somewhere or there's some nuclear fallout somewhere. What else can there potentially be for the markets?